Look, I think the big thing that happened with regard to Bitcoin this year is that Bitcoin is the first point in human history where engineering impinged on economics. Up until this point, people didn't really embrace the idea of energy theory and engineering theory and math and sciences as being integral to the way that a monetary asset functioned. It used to be money was, seashells and tokens, and then we have this, we have gold and we have coins, and then we have general agreements and the like. And Bitcoin was the first time when we created a digital monetary asset, a pure digital token on a pure digital network that actually respects the laws of conservation of energy. I say it's sound money, but that's the same as thermodynamically sound money, which is conservation of energy, which means mathematically proper. The pandemic and the events that took place in March of 2020. And what you saw was Main Street shut down. It literally shut down and came to a grinding halt. And Wall Street had an initial panic and a rapid recovery, a V-shaped recovery. And so we put those two together. You had an L-shaped recovery. Main Street just shut down. And then you had a V-shaped recovery, and we call that a K. But if you decompose it, and I was very sensitive to it because on one hand, in my personal life, I'm an investor. And in my public life, I run a Main Street company. I run a software company that has people that manufactures software that does things. So if you had a large portfolio of stocks or assets and you went into this pandemic, after the Fed ended up expanding the money supply with the interest rates going to zero and the expansion of the M2 monetary base, the money base, you found that you were actually 25, 30% wealthy or doing nothing. You could have done nothing the entire year. As long as, right, the only mistake you could have made is do something, right? If you had $1 billion and you did nothing for the entire year, you had $1.3 billion at the end of the year. On the other hand, if you had a Main Street company and you're generating, let's say, $100 million a year in cash flow and you're valued at $1 billion because of the cash flow, you would have to be generating $130 million after a year to be valued the same, because the value, the assets that the money buy is being devalued by 30%. If the currency is devalued at some rate, and the money supply expanded to 24% last year, so you could use that as your metric, or you could use the S&P 500's return as another metric. But clearly, the currency devalued, which means that if you're a Main Street company, you had to work 20% harder to get nothing. And if you're a Wall Street company, you had to do nothing to get 20% better. And so what I saw was a shift in balance of power, and a shift in wealth. And it was pretty disturbing to me too. It's like, you don't want to be the dentist working for a fixed amount of money that's getting 20% less valuable every year. The money is broken into two components. You have a currency component, which you use as a legal medium of exchange, like the dollar or the euro or the yen. And then you have an asset component, which you use as a store of value over the long term. Money or US dollars have ceased to be a store of value for at least the past decade, since the great financial crisis. So what people did was they stampeded into ETFs and index funds, right? And to a certain extent, bonds, right? How do you store your value over the long term? Well, if I take money and I buy a mixture of stocks and bonds, that will store my value, because if the economy is healthy, the stocks go up by 10% a year. The S&P does. And if the economy is not healthy, the Fed will lower the interest rates by 50 basis points and the bond will trade up. And so that works for how long? It works, watch the interest rates for the last decade. It works until you crank the interest rates down to zero. It used to be overnight money was 550 basis points, Tom, before the great financial crisis. And then they cranked it down from 550 to 500 to 450 to 400 to 350 to 300 to 250 to 200 to 150 to 100 to 50 to 0. And now we have, the bankers say, I'm not even thinking about raising interest rates. So that breaks bonds as a store of value unless you go negative interest rates. And stocks work, except for the fact that, what stocks worked in the past decade? Apple, Amazon, Facebook, Google, a big tech company that grows 20% a year top line. When Apple stopped growing 20% a year top line, they fixed it by taking on massive amounts of debt, buying their stock back, and leveraging up their EPS. So companies that grow faster than the rate of monetary inflation, faster than the 7%, they could hold value. A company growing 20% like Google, Facebook, or Amazon, they all hold value. In fact, they accrete value. Why? Because 20 is more than 7, right? So it's plus 13% a year, right? What happens to all the other companies? Which companies in the S&P 500 amounted to all the indexes, or to all the gains? It was big tech, right? Big FANG stocks were the winners. Everybody else treads water because if you're growing at 7% and the money supply is collapsing at 7%, you're net zero. And how else do you get around it? Well, you can go borrow a lot of money, leverage up, buy back half your stock, and get your cash flow per share up. But what happens when you're fully leveraged, which is like where they are right now? You can't do it anymore. So what's the problem right now? The problem today is the currency is being devalued at 20% a year, not 7% a year, right? I turned up the heat in the frying pan. And the second problem is some stocks could hope to grow 20% a year, like the minority, 5% of them could grow 20% a year for the past decade. What percentage of stocks can grow 30% a year? Because now you got to grow 30 or 35% a year because the hurdle rate just jumped. Now you're pushed out on the risk curve here. You got to take massive risk as a company to grow that fast. You got to do acquisitions. You got to burn the candle on both ends. You got to take on massive new leverage. This is squeezing. Value stocks don't work, right? I mean, it squeezes you out of the value stock trade because if the company is reliable and it's growing its cash flows 5% a year and the money supply is expanding at 20% a year, cash is trash. Back to my story, right? Why is cash trash? Because I had a value stock with a lot of cash and the money supply is expanding. Look at it from the point of view of an investor. They can invest in the S&P 500 index or the NASDAQ, and those were all up like 40% year over year or something, Or they could hold cash and get 0%. Nobody wants to hold cash.